Welcome to Stock Explained, where business, tech, stocks, and the economy are broken down into simple, clear insights. This video is for informational purposes only and is not financial advice. Now let's dive into today's topic.
Welcome to the Deep Dive. Today we're taking a deep dive into a stack of fascinating sources about the roller coaster ride that was the second quarter of 2025 for global markets.
Yeah, quite a ride.
You've sent us a lot to unpack, from detailed earnings reports to analyses of shifting economic winds, and even a look into congressional and insider stock trading. Our mission is to cut through the noise, extract the most important nuggets of knowledge, and give you a crystal clear understanding of what drove the markets, especially the tech titans, and what it all means for you. Let's unpack this.
Indeed, we're looking at a period where market sentiment showed some sharp swings, ultimately leading to a surprising finish. But the core question for this deep dive is, was this rebound a sign of broad economic health, or, just a narrow rally driven by a few powerful companies papering over underlying cracks?
That's a great question to frame our discussion. Okay, first, the big picture. Q2 2025 was a truly strong rebound quarter for U.S. stocks, effectively reversing some of those Q1 losses.
A big reversal.
Yeah, the S&P 500 climbed a robust 10.9%, and the Nasdaq soared even higher, up 18%.
Wow.
For those with a globally diversified 60-40 moderate risk portfolio, you likely saw a solid return of about 8.8%. So what exactly was fueling this impressive comeback?
Well, our sources point to several key factors that propelled such a strong recovery. We saw solid corporate earnings across the board, a clear investor resilience that led to buying on dips.
Right, buying the dips.
Exactly. And a wave of companies repurchasing their own stocks. And it wasn't just a U.S. phenomenon either. International stocks also rallied, partly supported by a weaker U.S. dollar, with Europe and emerging markets showing impressive gains.
Now here's where we find something truly noteworthy in our sources. They unanimously highlight a particular group that truly did the heavy lifting for this rally, the Magnificent Seven.
Ah yes, the Mag-7.
That's Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. As a group, they collectively returned 18.6%, significantly outpacing the other 493 stocks in the S&P 500 by over 14%.
Over 14% difference, that's huge.
How central were these tech giants to the Q2 story?
Their influence is undeniable. These 7 companies represent a significant portion of the NASDAQ 100's market capitalization, and their Q2 earnings reports marked a seismic shift in market sentiment. Microsoft and Meta in particular became catalysts, practically rewriting growth and profitability rules through their cloud and AI divisions. What stood out to you about their performance?
Well, for Microsoft, we saw strong overall revenue growth, up about 12% year over year to nearly $70 billion. Pretty solid.
Yeah.
But the real story was their intelligent cloud segment, which includes Azure, which jumped a staggering 19% to over $25 billion.
13%, okay.
And their AI business, that's projected to generate $13 billion in 2025, a massive 175% increase.
Wow, 175%.
They're embedding AI into workflows across industries, backed by an $80 billion capital expenditure plan for 2025, essentially. Their massive investment in new equipment and infrastructure. This isn't just growth, it's a structural shift.
That's right. Azure's annual run rate now exceeds $75 billion, a 34% jump from 2024, and its operating margin reached an impressive 45.7%.
45% margin, incredible.
It demonstrates how scale can coexist with profitability, even in the incredibly demanding AI infrastructure space.
And Meta wasn't far behind. They reported revenue of $47.5 billion, up 22% year over year, driven by increased ad impressions and pricing.
Also strong numbers.
But the real headline was their AI investments. Capital expenditure of $17 billion in Q2 alone, up a massive 101% year over year, with 2025 guidance of $64.72 billion.
Doubling down.
They're clearly betting big on what they call superintelligence.
Meta's aggressive capital expenditure reflects their long-term vision to redefine platforms like Instagram and WhatsApp with personalized AI. Their Q3 revenue guidance of $49 billion at the midpoint, which actually beat analyst expectations by nearly 6%, signals strong confidence in their AI roadmap despite Reality Labs' operating loss of over $4.5 billion in Q2.
Right, that Reality Labs loss is still there.
It is. But both Microsoft and Meta's strong results strongly reinforced what our sources call the artificial intelligence earnings narrative.
While Microsoft and Meta were undeniable catalysts, we also saw strong, albeit less dramatically detailed, contributions from the others. Amazon's cloud division continued its robust growth.
AWS, yeah.
Apple's services revenue remained a consistent driver, and NVIDIA, despite its Q1 dip, maintained its critical role in AI infrastructure, all playing their part in the group's overall strength.
Absolutely, they all contributed.
But not all the Magnificent Seven had the same smooth ride. Let's dig into some of the individual stories, starting with Alphabet, or GOGL.
Yeah.
They had strong Q2 results that surpassed expectations, leading to a notable uptick in share price, and there's a lot of intrigue around their boosted capital spending plans.
However, the ongoing Department of Justice case regarding Alphabet's search engine dominance continues to cast a shadow, with some speculating it could pressure the stock short term.
Always that overhang.
It's a mix of optimism and caution, for sure. One striking detail from our sources is the trading activity around GOGL. Members of Congress made 17 trades in the past 6 months. That's 7 purchases and 10 sales.
Interesting.
For example, Senator Shelley Moore Capito made 3 purchases up to $45,000, while Representative John W. Rose sold up to $5 million. It's always fascinating to see where politicians put their money, isn't it?
It really is. And when we look at insiders at Alphabet, it's even more one-sided. In the last 6 months, there have been 102 sales and 0 purchases.
0 buys, wow.
CEO Sundar Pichai alone sold 292,500 shares for an estimated $50 million. Yet, Wall Street analysts are overwhelmingly positive, with 23 buy ratings and 0 sell ratings, and a median price target of $210.
Quite the disconnect between insider selling and analyst ratings. And it's a similar pattern for Meta, which saw 32 congressional trades, 19 purchases, and 13 sales.
Okay.
This includes Senator Shelley Moore Capito with 2 purchases up to $30,000, and Representative Jefferson Shreve with 3 sales up to $550,000. Insider trading for Meta is also heavily skewed to sales, with Mark Zuckerberg selling over 500,000 shares for an estimated $359 million across 329 sales in the past 6 months.
$359 million.
Yeah. But again, analysts are very bullish on Meta as well, with 33 buy ratings and 0 sell ratings, and a median price target of $845.
So, incredible gains from Microsoft and Meta, some mixed signals with Alphabet. But not every tech giant enjoyed such a smooth ride.
Right.
In fact, one of the Magnificent Seven had a particularly challenging Q2. Let's shift our focus to Tesla, or TSLA, what's behind their recent struggles.
Yeah, Tesla's a different story.
Their revenue is down 12% year-over-year to $22.5 billion, and net income fell 16%. Deliveries dropped nearly 14% year-over-year.
Yeah, those are some tough numbers. A crucial point emerges here. What's impacting Tesla so significantly? Our sources highlight several pressures.
Like what?
Stiffer competition, especially from China's BYD, which sold over 606,000 battery electric vehicles compared to Tesla's 384,122 deliveries in Q2.
Big gap there.
Is clearly eroding their global lead. Tesla's U.S. market share has fallen from 75% in 2022 to about 43% in 2025.
75 down to 43, that's huge.
It really goes to show that even an undisputed leader can't rest on its laurels for a second in this market, does it?
Absolutely not. What else is hurting their profitability?
A major factor is their carbon credit revenue. This has been a lucrative, high-margin income stream with nearly 0 production costs.
Right, almost pure profit.
Exactly. In Q2 2025, that revenue fell by over 50% to $439 million, from $890 million in the same period last year.
Ouch, cut in half.
And our sources also note a proposed piece of legislation, what some are calling the One Big Beautiful Bill, or OBBA, from Republican lawmakers.
Okay.
Which aims to roll back climate programs and eliminate EV tax credits. This could further reduce demand for these credits, potentially cutting into Tesla's margins and earnings even more.
So, political factors are directly impacting their business model, which is fascinating given, well, Elon Musk's occasional support for deregulation.
Indeed, and investors are clearly concerned about how these political shifts add volatility to Tesla's future earnings. The company is also facing challenges with its energy generation and storage segment, which saw revenue fall 7% year-over-year to $2.8 billion.
So multiple headwinds for Tesla. Now, our sources also highlight that the Magnificent Seven actually had a surprisingly rough patch earlier in the year.
That's right, Q1 wasn't great.
How does that Q1 context make their strong Q2 comeback even more remarkable?
Well, it's a critical piece of context. Our sources indicate that the Magnificent Seven actually had their worst month and quarter on record in March, capping off a difficult Q1 2025.
Worst on record.
Yeah, the Roundhill Magnificent 7 ETF dropped 10.5% in March and was down more than 15% year-to-date by March 31.
15% down by end of Q1.
Tesla was the worst performer, falling more than 35% year-to-date, with NVIDIA shedding 20%.
NVIDIA down 20% too, wow.
This was partly attributed to a surprisingly efficient AI model from a Chinese startup, DeepSeek, which called into question the economic assumptions that underpin big tech's AI rally, along with lingering doubts about AI infrastructure payoff and even President Trump's tariff threats.
Oh, okay.
So seeing such a powerful Q2 rebound, especially for Microsoft and Meta, truly underscores their resilience and the market's strong belief in the AI narrative, despite those earlier wobbles.
Okay, so stepping back from individual companies, what does this tell us about the overall economic landscape in Q2 and what might be coming next for the markets? Does this strong stock performance truly reflect broader economic health, or are there, underlying cracks?
That's the key question. Despite the tech-driven market rally, there are underlying economic signals that demand attention. One significant factor is the labor market, which showed clear signs of cooling in May 2025.
Cooling? How so?
Total non-farm payrolls rose by a below consensus 73,000 jobs, and there was a shockingly significant downward revision of 258,000 jobs from previous months.
250,000 jobs revised away. That's significant.
It is. The unemployment rate rose to 4.2%, and the employment to population ratio for prime-age individuals deteriorated. So some definite softening there.
So the job market is softening, even with the strong stock performance. What about inflation and the Fed's next moves? Still sticky.
Inflation remains sticky. Yeah. The Federal Reserve held interest rates steady at 4.50% for the fourth consecutive meeting in June.
Fourth meeting in a row, okay.
Core PCE, that's the Personal Consumption Expenditures Index excluding volatile food and energy. The Fed's preferred gauge edged higher to 2.7%.
Still above target.
Right. Fed Chair Jerome Powell cited tariff-driven inflationary pressures as a reason for delaying further rate reductions, although the possibility of 2 additional rate cuts by the end of 2025 still exists, albeit with uncertain timing.
And those tariffs, as you mentioned earlier, are definitely a recurring theme. President Trump announced new reciprocal tariff rates effective August 7, adding to overall economic outlook worries.
Indeed. This brings us back to that central question about the tech sector specifically. While the Magnificent 7 earnings growth rates are still expected to exceed the rest of the S&P 500, our sources note that the point of earnings convergence, that's when the growth rates of these tech giants and the rest of the S&P 500 are expected to align more closely, has been pushed out again, now to Q1 2026.
Pushed out again, so it implies the Mag-7's outperformance is expected to continue for a while longer.
Seems like it.
But I also saw a fascinating detail about the tech sector's market cap versus its net income share. What's the implication there?
Yeah, that's interesting. The intriguing aspect here is a widening gap. Since late 2022, the tech sector's market capitalization as a proportion of the S&P 500's total market cap expanded from about 22% to over 32%.
Big jump in market cap share.
Huge jump. Yet its net income as a proportion of the S&P 500's total net income only rose from 21% to 23%.
Only 2% increase in income share.
Right. So the market cap share grew much faster than the actual profit share. The key insight for you here is that while AI innovation is undeniably powerful and driving market excitement, much of that future growth for the tech sector might already be baked into current valuations.
Meaning expectations are very high.
Extremely high. This suggests future returns could hinge more on sustained, profitable innovation rather than just impressive top-line growth. It urges caution, not dismissal, but definitely caution about being overweight tech right now.
Makes sense. Beyond the tech buzz, what else shaped the Q2 markets? Did commodities or bonds play a significant role?
Absolutely. Bonds did exactly what they're designed to do, adding stability and support to portfolios. U.S. investors saw returns jump to 7.3%, so good performance there.
Okay.
In commodities, it was a bit of a mixed bag, really a tale of two assets. Gold surged 5.2% in Q2, making it up 24% for the year.
Gold shining bright.
Yeah, acting as that safe haven amid global uncertainty. But oil prices pulled back after an early spike, and natural gas saw a steep decline of 16.1%.
Big drop for natural gas. Okay. So, what does this all mean for you, the learner, keen to stay well informed? Q2 2025 was a powerful rebound for U.S. stocks, largely powered by the Magnificent Seven and the ongoing AI narrative, especially for companies like Microsoft and Meta.
And by tech led.
But underneath that surface, we've seen significant individual struggles for some like Tesla, concerns about a softening labor market, persistent inflation, and the looming effects of tariff policies. Lots of cross currents.
Yeah, it highlights the critical importance of a balanced perspective. While the tech giants continue to lead the charge, driven by innovation and substantial capital allocation in AI, our sources suggest caution regarding their current valuation relative to their actual income contribution. That gap we talked about.
Right, that valuation gap. It's clear that the markets are navigating a complex landscape of innovation, economic shifts, and political currents. Understanding these interwoven narratives is key to truly being well-informed.
Absolutely. Yeah. And for you, the listener, this raises an important question. As the AI arms race continues and economic signals remain mixed, how might the shifting balance between technological innovation and macroeconomic realities shape investment strategies in the coming quarters?
A key question indeed.
Could a broader market recovery eventually catch up to the tech giants, or will the Magnificent Seven continue to defy gravity? Something to think about.
Thanks for watching Stock Explained. If you found this video helpful, hit that like button, subscribe, and tap the notification bell so you never miss an update. Drop a comment with your thoughts or questions. We'd love to hear from you. See you in the next video.